All right, let's jump straight into today's action-packed explainer. It's June 19th, 2026, and look, the crypto market is taking a massive, massive beating right now. It's literally testing the resolve of every single investor out there. But as we're going to see when we dive into the data today, this intense, crushing pressure, it's actually setting the stage for an epic power-up. We're going to unpack exactly what's dragging the market down, who's pulling the strings behind the scenes, and why top on-chain analysts are saying this painful flush is exactly what we need for the next major bull run. So here is our battle plan for today. We'll start by marching straight into the extreme fear currently gripping the market. Then we'll uncover the whale traps and options expiries pulling prices down. After that, we'll pan out to look at massive global geopolitical shifts, spotlight the altcoin resistance fighters totally defying gravity, and finally, decode the ultimate down first, then up endgame thesis. Starting off with Section 1, into the extreme fear. We're kicking things right off in the thick of the action, guys, where market sentiment has taken a totally brutal hit. Check out this imposing number, 15. That is today's fear and greed index. Out of 100, a 15 is firmly in extreme fear territory. I mean, panic is literally gripping the battlefield right now. With Bitcoin hovering around that $63,000 to $64,000 mark, it's actually pulled back roughly 52% from its October 2025 peak. The market is desperately searching for a bottom, but right now, all anyone sees is red. Now, the massive gravitational pull causing all this fear is a newly hawkish Federal Reserve outlook under Chair Waller. The message was loud and clear. Combating inflation is still their absolute top priority. Because of that, investors are now fully pricing in a 25 basis point rate hike for September 2026. This hawkish stance is basically acting like a giant gravity well, pulling down global risk assets and severely tightening up crypto liquidity across the board. Moving right along to Section 2, whales, traps, and expiries. Let's look at the hidden bosses manipulating the battlefield behind the scenes here. So the really crucial point here is that we're absorbing a staggering multi-front assault today. First up, a massive $2.13 billion options expiry for Bitcoin and Ethereum just hit. And both assets are trading below their max pain levels, which really underscores just how cautious traders are right now. We also saw $102 million in spot ETF net outflows yesterday. And if you really want to see what textbook capitulation looks like, get this. One whale, identified on-chain, just dumped 800 Bitcoin at a massive $35.3 million loss after holding it for 7 months. Ouch. I mean, that is a heavy, heavy flush of capital. But here's the data point that totally explains why the market feels so sluggish. According to on-chain analyst James Check, over 70% of the wealth invested in Bitcoin right now has a cost basis above $90,000. Think about that for a second. With Bitcoin trading near $63,000 a day, a supermajority of recent buyers are deeply, deeply in the red. This creates a really top-heavy market structure. Basically, every single time the price tries to bounce, all those underwater investors just look for an exit at break-even, which creates these massive sell walls. And to understand just how unbalanced power dynamics can get in crypto, you just have to look at the TRB Oracle token. A mere 14 wallets, yeah, just 14, control a dangerous 76% of the entire token supply. It's an extreme example of concentration risk. When you have an asset with no maximum supply and a handful of whales controlling 3/4 of the float, well, you get insane volatility. We've seen TRB jump 220% in a matter of days, only to completely crash 50% in 24 hours. It's a stark reminder, guys. Always check the on-chain data before you engage in these highly concentrated battlegrounds. All right, let's hit Section 3, geopolitics and global shifts. We need to pan out for a second and see how real-world truces and regulatory hammers are shifting the whole global liquidity landscape. We're neutrally observing some massive real-world catalysts shifting risk appetite today. On the global stage, the US and Iran have signed a memorandum of understanding for nuclear negotiations in 60 days. Meanwhile, Israel and Hezbollah have reportedly agreed to a ceasefire. These moves could definitely stabilize global macro sentiment. But back stateside, the regulatory grip is tightening up. FBI Director Kash Patel has issued a really firm vow to hunt down and prosecute crypto scammers, signaling intense federal oversight. And on the state level, Illinois just enacted a new 0.2% digital asset tax taking effect in January 2027. So the rules of the game are clearly evolving right before our eyes. Moving to Section 4, altcoins define the gravity. Despite the heavy hits and regulatory shifts we just talked about, let's look at the resistance fighters completely define the odds in today's session. This juxtaposition is just wild. On one side, the heavyweights are bleeding out, but on the other, select altcoins are surging. We're seeing Audiera and DEXE putting up double-digit gains. And crucially, XRP has defied the crash entirely. It's pulled in $79 million in spot ETF net inflows over the last 10 trading days, largely thanks to massive institutional interest in its new zero-knowledge proofs integration for confidential finance. Add in some massive technological leaps, like MegaETH launching its public alpha mainnet with a staggering 100,000 transactions per second, and it clearly shows that capital is actively rotating into specific, high-growth tech ecosystems even when the macro environment is totally fearful. And adding to this altcoin resilience, the Wall Street Titans are absolutely not backing down. Morgan Stanley has reportedly filed for new Solana and Ethereum ETFs that actually feature built-in staking capabilities. So while retail might be swept up in all this extreme fear, the biggest institutional players are quietly charging up. They're building out the infrastructure for the next massive wave of capital deployment. Which brings us to Section 5, down first, then up. Let's decode the ultimate endgame for 2026 using all the data we've gathered so far. Top on-chain analyst James Check sums it up perfectly. He states his ultimate theme for 2026 is down to go up. He argues that going lower right now is actually more bullish than a slow, boring sideways grind. You kind of need prices to drop to shake out the weak-handed bulls, form a true capitulation candle, and get the bears to over-leverage their short positions right at the exact bottom. But the bigger picture here really relies on what the central banks will be forced to do next. He outlines this crystal-clear tactical sequence for us. Step 1. The hyper-financialized equity markets, maybe driven by an overextended AI bubble, begin to crack. Step 2. This causes a negative wealth effect. It halts consumer spending and leads to a recessionary flush. Step 3. The Federal Reserve, completely regardless of who's in charge or how hawkish they sound today, will be absolutely forced to shift from tightening to injecting massive liquidity just to keep the system afloat. And finally, Step 4. This inevitable fiat currency debasement acts like pure rocket fuel, triggering a massive, unstoppable recovery arc for hard, decentralized assets like Bitcoin. So the current pain, it's literally just the setup for the next major expansion. So I leave you with this final thought to ponder as you review your portfolio and stare down all this market fear. Understanding the macro setup and the on-chain realities we've explored today, will you let the heavy whale traps and hawkish headlines shake you out? Or are you holding the line, positioning yourself for that ultimate liquidity-driven recovery arc? Keep studying the data, stay focused, and I'll catch you in the next explainer.